Hi, and welcome back. We've reached our final module, and you'll notice that we're transitioning away from talking about working for the money and starting to talk about having the money work for you. In this module, we'll be going through strategies on creating long-term wealth by putting your money to work. What does this actually mean? It simply means that you do not have to put any effort into generating your income. Instead, where you choose to put your money, you'll have the money multiply and grow for you. Is this even possible? Well, yes. One of the methods to do this is by investments. Investments are used to make money work and generate passive income, where adding passive income streams to your portfolio can aid you in increasing your earnings, as well as accelerating your financial goals in other tremendous ways. The term investment can be used to refer to any mechanism used for the purpose of generating future appreciation in income. Referring to the context of our modules, investment is a monetary asset purchased with the idea that the asset will provide income in the future or will be sold later at a higher value for profit gain. There are many vehicles for you to choose from in order to start your investment. These may include bonds, stocks, mutual funds, real estate, gold, silver, as well as Forex. Of course, to decide which investment vehicle is best for you, you need to know their characteristics and why they're suitable for a particular investing objective. But for this particular module, we'll only be focusing on 3 investment vehicles, which are gold, silver, and property. We'll elaborate each vehicle further in the coming modules. A surefire way to gain long-term wealth is investing in gold and silver. First, let's talk about investing in silver. The investment offers a lot of different options. We'll go through a brief overview of the focal points and conveniences of purchasing the most well-known silver bullion and silver coin speculations. What makes silver? Silver, just like gold, has been used across time. Research shows that silver is used mostly as coins since early days. However, unlike gold, silver has a variety of industrial and commercial applications. This is because silver is more flexible in its characteristics than gold. It remains the best electrical conductor known to man, highly resistant to corrosion. It's among the most malleable and ductile metals, and it's a splendid thermal conductor. The rarity of metals denotes their value increment. Such is the case in silver, where silver is a byproduct of different base metals, copper, lead, and zinc. 90% of the world's silver mining industries experience bankruptcies. The world is running out of silver. There are several reasons why you should invest in silver. The value will always appreciate in the long run, where the value of silver is stable regardless of the currency that you're purchasing it with. The increment of its value, due to its demand in various fields or industries, will always be great. The space between supply and demand is getting wider, leaving little amount of silver left to sell, so there's scarcity. Consequently, as we can see, the global demand of silver is growing. For example, all of the following uses of silver are growing: medical, electronics, food processing, water treatment, building materials, and consumer products. The focus here is that all of these items are on demand. So even during an economic downturn, there will be a high level of base demand. In terms of investment, the investment demand is soaring, especially in the USA. The US Mint sold more 1-ounce silver eagles in January 2013 than in any other month since they began creating silver in 1986. Other than that, total global demand of silver in the recent years is about 880 million a year, where the worldwide mine production is only about 760 million ounces per year. This example clearly demonstrates how silver is still relevant, where the demand exceeds the supply due to its practicality. Generally, you can invest your resources into silver in 3 ways: silver bullion and coins, silver bars, and exchange trade funds, or ETFs. The easiest is to purchase silver bullion specifically. Coin and valuable metal merchants offer silver bullion both face-to-face and in digital transactions over the web. You can go to any place from 1 ounce to a 1,000 ounce bar, decently and promptly in the silver market. The benefit of bullion is that once you have it, its value is entrenched and matches the silver marketplace. Silver price is historically more volatile than the price of gold, in that the value can change rapidly. In other words, the price of gold will rise, where based on historical volatility, the silver price would be expected to rise by a higher percentage than the gold price. The drawback is that merchants charge markups to offer you silver, and on the off chance that you need to trade out your bullion later, the merchant potentially would give you a price that does not match the overarching price of the market. Meanwhile, buying silver bars has also been proven to be an excellent tactic in preserving long-term wealth. As an investor, you should firstly be sure to determine the right size and type of silver bars used as a primary investment tool. Silver bars come in various sizes and weights, while most bars sell in troy ounces in increments of 1 ounce, 5 ounce, 10 ounce, 1 kilogram, 100 ounce, and 1,000 ounce bars. Some mints sell them in fractional or gram sizes. There's no right or wrong weight in purchasing silver bars, as this is a personal choice. Generally speaking, investors who choose to purchase a large bar find that it gets them the most bang for their buck. For the purchase of smaller sized silver bars, it's easier to liquidate. Now, let's look at how silver ETFs work. When you buy gold and silver physically backed by ETFs, you do not possess the physical metal, but you own a paper representation. With respect to the ETFs, for every share you buy, you own an ounce of silver. A custodian, usually by large banks, stores the actual metal. The share-to-metal correlation erodes the longer you hold the shares. The fund must sell silver, for example, periodically to pay for expenses, which decrease the amount of silver allocated to each share. Silver exchange rate is at 1% to 2% the cost of gold. It's difficult to consider silver as a genuine valuable metal compared to gold. However, it still has its noteworthiness in the eyes of investment. In the previous module, we discussed the value of silver and investment techniques for silver. Now let's move on to gold. Gold has been widely used since before the existence of paper money or fiat money. Research shows us that its usage was detected for over 3,000 years, but how can it retain its appreciated value? Well, its characteristics are what makes gold gold. It's simply beautiful, it's ductile, it's highly scarce, and it's extremely durable. Therefore, unlike paper currency, coins, or other assets, gold has maintained its value through time. People perceive gold as a way to preserve their wealth from one generation to the next. So why should you invest in gold? First off, the weakness of the US dollar. Although the US dollar is one of the world's most reserved world currencies, when the currency's value dropped against other currencies, both in '98 and in 2008, this resulted in more investments in gold, which raised the price. The price of gold nearly tripled during the years of currency downturn, reaching around $1,000 per ounce. Meanwhile, from 2008 to 2012, the price of gold escalated to almost $1,800 or $1,900 per ounce. So there's an increase in demand as well. In previous years, increased wealth of emerging markets boosted the demand of gold. In some countries, gold plays a significant part in culture. For example, in India, where the wedding season in October is traditionally the time of year where there will be the highest demand for gold. Meanwhile, in China, gold bars are a traditional form of saving, where the demand of gold has been steadfast. Investment-wise, many individuals are beginning to see gold as a commodity, as an investment class into which funds should be allocated. Gold should be an important part of a diversified investment portfolio, as its price generally increases in response to events that cause the value of paper investments, such as stocks and bonds, to decline. Although the price of gold can be volatile in the short term, it has consistently maintained its value over the long term. Throughout the years, it has served fairly as a means to hedge inflation, as well as the erosion of major currencies, making it an investment worth considering. Now let's move on to gold investment techniques. There are several ways to invest in gold. Gold coins, which are convenient and portable. Gold bars, which are cheaper in bulk, even cheaper than the same weight of gold coin. And then exchange traded funds, or ETFs. When you purchase gold coins or bullion, maintain a strategic stance from huge premiums. Coins regularly originate from the National Mint, where they're made and sold at a 4% increase. The retailer's edge is 1 to 3%. To figure the premium of a gold item, subtract the spot cost from the value you're being cited. Separate that number by the spot cost and increase by 100. On the other hand, purchase physical gold at different costs: coins, bars, and adornments. The most common gold coins are American Buffalo, American Eagle, and St. Gaudens. To prevent from getting ripped off, build up your reason why you need to purchase gold bullions. If you're planning to invest in gold as a long-term venture, then purchase gold as close to market value as you can. These tips will help guarantee that you get great value from your investment. Your savings will also depend on the quality of the gold you choose to invest in. For gold bars, you have to be aware that it comes in many different shapes and sizes, where buying in bulk will save you a lot of money. There are more than 30 types of gold bars in the world's regional market today. At the most expensive end of the gold bar spectrum is the 1-gram novelty gold bar that's minted for the gift market. Often coated in plastic, these may cost at least twice the cost of their gold bullion content. Cheapest of all is the 400-ounce or 12.4 kilo good delivery gold bars held by central banks. Buying gold bars is almost always cheaper than buying the same weight in gold coins, and the bigger each bar, the lowest cost by weight. Depending on your local tax regime, you can reduce or completely avoid paying sales tax or VAT by buying gold bars instead of coins. Moving on to gold ETFs. As mentioned in the previous module discussing silver investment techniques, when you buy gold and silver physically backed by ETFs, you do not possess the physical metal, but you own a paper representation. The difference between silver and gold ETFs is that with respect to the ETFs, for every gold share you buy, you own 1/10 of an ounce of gold. A custodian, usually a large bank, stores the actual metal. The share-to-metal correlation erodes the longer you hold the shares. The fund must sell gold, for example, periodically to pay for expenses, which decrease the amount of gold allocated to each share. The next step is to invest in property. Property investment is when you own or buy a property that you're not staying in and is generating income for you. This sort of income is passive income. With your business expansion, you'd want to keep your surplus of finance invested in precious metals or property. If the money only sits in a bank and does nothing, it will devalue over time due to the cost of inflation. Money, when not working, gets lazy and fat, and that is exactly what happens in a bank. A mere 1 to 3% interest rate gained is not enough to hedge against inflation of 10% or higher. There's a 7% gap at least. There are 3 steps to start investing in property: checking your funds, managing your finances, and creating an investment plan. The first step is to check your funds. This will give you a rough idea on the amount of cash that you have readily available to invest, or the remaining gap to invest. In this step, you would also need to understand all the costs involved in acquiring and maintaining a property, especially if it's your first time investing in one. If you do not do your research, it's easy to fall into the trap of a rookie investor. The property bought will have poor cash flow because after netting off all the uncounted expenses, net profit or net cash flow may be low to negative. To hedge against this is step number 2. Plan out a budget and manage your company profit and loss sheet, ensuring that recurring and operational costs are low and profit margins are healthy. A recommendation is to allocate 10 to 20% of company net profits into investing into property. Be disciplined about this, and after 1 to 3 years, you'll find the company assets have doubled or tripled over the years because of the capital appreciation of good property. Step 3 is to create an investment plan. A successful long-term wealth creation through property investment requires that you set your personal goals, decide where you would want to end up, and then formulate a plan to get there. The purpose of the plan is to serve as a structure for you to stay in the game. Your investment plan may include detailing your strategy, doing your research, and setting up your preferred criteria for investment. Welcome back. Now that you're familiar with how to invest in property, let's focus on property investment technique. To start investing in property, these are the fundamentals that you have to know. The price tag of the property, the amount it will cost to maintain the property, how much rental pay you'll get, if of course you're planning to generate rental income, how much your home loan reimbursements will be if you're planning to generate capital gains. Your property venture group is one of your best resources as you develop your property portfolio. Research your group before you begin putting resources into property and cash over the long term. Your group will incorporate many other roles. The must-have roles in your property speculation group will include your ANZ, Home Credit and Protection Authorities. They assist in home loans. Your legal advisor. Their task is to safeguard your legal rights and facilitate the transfer of your property. And your accountant. They provide financial guidance and assistance during real estate transactions. They also prepare financial reports on behalf of property owners and real estate developers. The last step is to set your investment goals. Goal setting is important in investments because if you don't have a clear goal, you'll fall for everything. Then at the end, you'll end up having many different investments which may be giving you good returns, but really have no strategy. It's not an effective move because if you had pooled the money together, you'd be able to invest with a clearer direction. To do this, sit down with your financial advisor and chart out your strategy for the next 1 to 3 years. You should include projections based on current market trends to see if an investment vehicle is worthwhile to be in. After your plans have been laid out, the next part is to execute the plan. In summary, don't be afraid to invest. It would be foolish not to invest because money that's not put to good use loses its value over time, even more so when it's just sitting in the bank not doing anything.